Today, we're going to pull back the curtain on the method behind almost every undervalued or overvalued stock you hear about. We're talking about relative valuation. It's the go-to, intuitive, and yes, sometimes risky way the market puts a price tag on a company.
So let's just kick things off with a really fundamental question. Forget about stocks for just a second. How do you figure out the price of anything? A car, a house? It's a puzzle investors are up against every single day.
Well, the simplest answer is usually the most powerful one, right? You just look at what similar things are selling for. And that, right there, is the core idea of relative valuation. You're not trying to calculate some abstract universal value from thin air. Nope. You anchor your guess to real-world prices. It's practical, it's market-based, and it's all about what people are actually willing to pay.
All right, here's our game plan for this explainer. We'll start by cracking open the valuation toolkit to really get a handle on multiples. Then we'll zoom in on the famous PE ratio. And after that, see how this all works in practice. We'll wrap up with a super important reminder. This is a tool, not a golden rule.
Okay, let's get right to it and open up our valuation toolkit. You see, when we talk about relative valuation, what we're really talking about is using multiples. Think of them as the essential wrenches and screwdrivers for any financial analyst.
So what in the world is a multiple? It's just a ratio, really. It standardizes a company's value against some key metric. So instead of trying to compare a $100 billion giant to a $1 billion upstart on price alone, which is useless, we can see how many dollars the market is paying for each dollar of their earnings. It's all about making an apples-to-apples comparison.
Now this brings us to let's call it the central conflict with multiples. On one side, they are insanely popular. Why? Because they're fast, they're easy to explain, and they perfectly capture the current mood of the market. But on the other side, that's also their biggest flaw. They can totally ignore huge details like risk and growth. And if the entire market is in a bubble, well, your valuation is going to be bubbly too. It's a real double-edged sword.
And this toolkit, it's got all sorts of specialized tools. You've got your earnings multiples, like the PE ratio, or EV/EBITDA, which is a bit more complex. Then you've got multiples based on book value, or even revenue, which is super useful for companies that aren't profitable yet. Some industries even have their own quirky, unique multiples that only they use.
All right, let's zoom in on the undisputed king of all multiples, the price-to-earnings ratio, or PE. If you've ever glanced at a stock quote, you've definitely seen this number.
At its core, the PE ratio is just beautiful in its simplicity. You take the company's current stock price and you divide it by its earnings per share. The number you get tells you how many dollars an investor is willing to pay today for $1 of that company's earnings. So a PE of 20, that means the market is shelling out $20 for every $1 of profit.
But, and this is a big but, here's where things get a little slippery. The P and the E aren't always what they seem. Is the price today's closing price, or maybe an average? And the earnings? Oh, that's even more complicated. Are we talking about the earnings from the last year, or what analysts think the company's going to earn next year? Depending on what you choose, you can get very different PE ratios for the very same company. So what makes one company deserve a high PE ratio while another doesn't? Well, it really just comes down to the fundamentals. Investors will pay a premium for growth because they're buying into the future. They'll demand a discount for risk because there's a higher chance those future earnings never show up. And they'll reward companies that can grow efficiently without needing to pour tons of cash back into the business all the time. Now, because growth is such a huge piece of the puzzle, analysts came up with a pretty clever little tweak called the PEG ratio. It's a shortcut that tries to level the playing field by directly factoring in how fast a company is expected to grow its earnings. A simple idea, but a powerful one.
Let's make this feel real for a second. Imagine a company with a PE ratio of 23. On its own, that might seem a little pricey. But what if we also know that analysts expect its earnings to grow by a whopping 25% next year? So we've got a PE of 23 and a growth rate of 25%. Let's do the math.
You divide that PE of 23 by the growth rate of 25, and you get 0.92. Okay, cool. But what does that number actually mean for us?
Well, there's this really popular, though, very simplified rule of thumb in investing. A PEG ratio under 1 could suggest a stock is undervalued for its growth. So that 0.92 tells us that once we account for that monster growth rate, the company's price might actually be more reasonable than its PE ratio first made it seem.
Okay, so we've got our tools. PEE, PEG, all the others. Now for the really important part.
How do analysts actually put these things to work to figure out what a company's worth? Turns out there are two main playbooks.
The first one, and by far the most common, is called comparable company analysis, or just comps. The logic is pretty straightforward. You find a group of similar public companies, you figure out their valuation multiples, you calculate an average, and then you apply that average multiple to your company to see what it might be worth in today's market.
The second playbook, precedent transaction analysis, uses the exact same logic but with a totally different set of data. Instead of asking, what are people paying for similar stocks right now, it asks, what have buyers paid to acquire entire companies like this one in the past?
And that right there is the key difference. Comps show you what the public market is thinking. Precedent transactions show you what a buyer was willing to pay for total control of the business. That price often includes something called a control premium. It's the extra cash you pay for the power to change strategy, fire the CEO, whatever you want. And that's exactly why precedent transactions often give you higher valuation numbers. All right, we've covered the what, the why, and the how. But before we finish up, we have got to read the warning label that comes with this toolkit. Because as powerful as these methods are, they are absolutely not foolproof.
Which really brings us to the final critical question. Is this whole approach a brilliant shortcut for finding a company's value? Or is it a dangerous trap just waiting to lead you off a cliff?
And the answer, of course, is it's both. The greatest strength of relative valuation is that it's tied to the market. Its greatest weakness is that it's tied to the market. If an entire industry is overvalued, your analysis is just going to confirm it. Which leads us to the single most important takeaway. Your valuation is only as good as your comparables. You have to ask yourself relentlessly, are these companies really comparable?
And that leaves us with this final thought to chew on. Using multiples and comps can tell you, with pretty decent accuracy, what the market is willing to pay for something right now. It's a snapshot of the mood, the price. But what it can never do is answer that deeper, much harder question. Is the market right in the first place? And that's a question every single investor has to answer for themselves.